Conviviality, the retail and wholesale cut-price drinks distributor, has been in the news recently for all the wrong reasons. Its chief executive, Diana Hunter, has had to resign following 2 profit warnings at the company. What it says was an unforeseen £30 million tax bill and the need to tap investors for money. Chris Boxall from Fundamental Asset Management joins us now. Chris, this is a company that started life back in 2013. It made a big acquisition, of course, a couple of years later. What's gone wrong?
Well, we think the signs were there post-IPO, and we always encourage people to read the admission document. And the Conviviality Retail, let's remember it was called Conviviality Retail when it listed, clearly laid out the strategy, as the admission document does. It laid out the strategy for the business, which was growing its franchise outlet offering, which was all built around the bargain booze, which are popular in the northwest of England largely. And that was the focus of the strategy, supporting franchisees, improving efficiencies. And they commented at the time, actually, you know, their substantial buying power, because they had so many of these outlets they were supporting. So it wasn't as if they didn't have the buying power in that space. So we really recommend people read admission documents. In that admission document as well, you'd have seen that private equity sold out entirely on IPO. So that they departed. We're always wary when you have a wholesale departure of an existing owner. That, you know, are they selling at the top? Is this being packaged up for sale, packaged up for IPO? And we think there are signs of that, because you can see then a year or so, within the first 4 years' results after IPO, you could see that actually the business, the organic growth was non-existent. I think earnings per share like-for-like actually dropped, like-for-like sales dropped. You know, there were already signs that this business was not perhaps performing as well as people had hoped. And suddenly, 2 years later, when we see these struggles, huge acquisition.
Yeah, I know on your blog you've been talking about this a while back. Let's take a look at the share price chart, because I think this sort of says a lot. This goes back to 2015, which is following on from that acquisition. You can see the way in which the share price has risen and risen. We're here to talk about red flags. We're here to talk about some of the big things that you're watching. You mentioned a few of them when you're going through company accounts. Now, you're an accountant, so
absolutely.
It's probably second nature to you, but anybody investing in these markets who doesn't have the experience that you have, what are the big things that we should be looking for? You mentioned a couple of them just now, but I mean, what sticks out a mile to you?
Well, everybody can read, and if even they don't know numbers, they can get a sense of what's going on at the business. And if you can see a wholesale, suddenly as we get to 2015, a wholesale change in strategy. So from a business going from supporting franchisees for suddenly one acquiring Matthew Clark, which is essentially just a big wholesaler of alcohol, and I think they call it impulse goods. I mean, I've never seen that term before, but it's a new one to me. But so they huge acquisition, investors ponying up a load more money again, and it just didn't make sense to us. And that is not, no accounting knowledge is needing there. It's just common sense and logic. Evidently there were, you know, growth issues in one business, and so that it was almost in our opinion, a bit of a desperate move. Now we reassess things. We used to hold these shares originally, and we're getting a bit worried, and we reassessed things after that acquisition, and became very concerned about this giant business that was now operating all sorts of different sectors. Again, focus. Again, ignore the numbers. Just common sense. You need focus. And having focus, saying they were going to focus on franchisees, they're now focusing on wholesale distribution to huge restaurant chains. And this is before even touching the results. You know, if we extend onto the results, they're probably, you know, the obvious red flags start to appear.
Such as?
Such as cash flow, poor cash flow. If cash flow really starts to come under pressure, it's an instant red flag for us. Growing inventory levels, lack of consistency year to year. You can't just pick 1 year, you've got to see how it compares to the prior year. So don't just be fixated on 1 or even 2. Try and get an idea of what this business should be doing. Huge amounts of capital expenditure relative, lots of cost to sort things out, lots of exceptional items. We hate exceptional items that aren't truly exceptional. We live in an age now where the companies delight in offering everything as an exceptional. the ongoing reference to adjusted EBITDA, we call it the fairy tale of adjusted EBITDA. If you're failing to meet adjusted EBITDA, something is going desperately wrong. And this was starting to happen in this business.
And of course, looking back at the headlines as well, I noticed that the CFO left, I think, in autumn last year.
Absolutely.
And if we go back to the share price chart, you can see quite clearly that as the share price started to crown, that's the point he left. And looking back, that's something that I, as a non-accountant, would say, oh yeah, that would have been a red flag. But at the time, it's just a turnover of staff.
It is, and there were other, which were less obvious, there were other changes of senior management, but not necessarily at board level. So you were seeing a lot of other things going on. Somebody's made a comment to us who knows this sector well. You know, I think the manager of one of their largest divisions left as well, which was also a bit odd. Yeah. But you keep going back to that aim and mission document. It's fantastic reading. It tells you all about the market, tells all you about the strategy. Remember, they went in 2013, they were going around the city raising, I don't know what it was, 30 million, 40 million on the basis of that strategy. You know, that's a lot of money, a lot of investors. To suddenly turn around and basically, essentially admit that it's not working was a bad sign in our opinion.
Yeah. Whilst we're on the downside, you've also flagged Acrol, haven't you? And this is a company which is, if we bring up that share price chart, this goes back to the admission to the markets back in the middle of 2016. What's this big gap here, and what should we learn from this company's accounts?
Returning, in our opinion, the same problem. It's a big private equity or founders sell down on IPO. The slight difference here is, well, we're always wary of that. When there's a big exit on IPO, big selling shareholders, and we struggle to understand why big institutions are so in love with these businesses on IPO when other people are swanning off. There has to be a very valid reason. It has to come in very, very cheap. That instantly made us, wary of this one. It's not in the most exciting sector, a bit like conviviality. It's a tough old sector, making toilet rolls, tissues for our own brand, for the likes of Aldi, Lidl. It's tough. It's just a price. There's no pricing power there at all. There's no brand strength whatsoever. It's just a matter of selling it, making it as cheaply as possible and selling it as cheaply as possible. And then you have some profit warnings. Again, it's the cash flows going all over the place, costs are soaring, and this one now, having warned that costs were extremely high, they found that they underestimated that it's going to be even worse than they anticipated. But it's another case of a business where the signs were all there. I mean, we've commented as well on conviviality and perhaps to a lesser degree on Acrol. We love to see committed management, and the CEO of Conviviality over the last, I think, 3 years has taken out nearly £3 million in remuneration. Up until recently, she had no equity stake in the business, real equity, real skin in the game, having put money, hand in her pocket and paid for shares. She's come out recently, but everything was option-based. We don't, that's not aligned with other shares, in our opinion. We can't understand why, when a company's going to investors for 40 million, those same investors don't say, okay, we'll put in, how much are you putting into this? You've been paid nearly £1 million last year, or 800,000. How much? I don't know your circumstances, but clearly you could put a little bit in.
So what should we focus on? What are the positives to look for when these small cap companies, and they go through various transitions very early on in their lives?
Absolutely, yeah. Well, underlying market, it's nice to see if your underlying market's growing. If you're at a starting point where the market's tough, you have no differentiator to anybody else, and it's purely price cutting operation, you're already off to a bad start. If there's no growth in that market, nothing's changing. We like to also see a focused approach. Stick to your knitting. Don't change. Stay the course. You know that sector. You should be in a better position than others to make it work. When you have to jump sectors, jump into all sorts of other things, already a problem. Committed management with skin in the game. We love entrepreneurs driving things, founders of the business still there, family ownership. They won't let things really mess up. They want, when you've got so much money, and real money, not just option based, when you've got a real commitment in there, I think it's a great strength. great cash flow. Look at the cash flow, look at the return on equities. This now we're moving to the accounting elements, but these are simple things. They don't have to knock the light out, but if they do these little basics, and there's a founder in there still driving it, and somebody with real commitment, we think that's an obvious sign that things could do very, very nicely.
Okay, Chris, right. Thanks so much indeed for joining us with our look around a couple of stocks worth looking at in terms of some of the red flags to watch out for when you see those reports from these small cap companies. That's Chris Boxall from Fundamental Asset Management.